George Soros once said something that sounds almost impossible. Markets don't simply reflect reality, they help create it. Most investors spend their lives believing prices follow facts. Soros spent his career proving that sometimes facts begin following prices. That single idea earned him billions of dollars and changed how many people think about financial markets forever. Think about this for a moment. Imagine a rumor spreads that a company is destined for greatness. Investors rush to buy its stock. The rising share price attracts media attention, analysts become more optimistic, banks become willing to lend, talented employees want to join the company, and suddenly the business actually becomes stronger. The belief didn't just predict success, it helped create it. That's the psychology of reflexivity. George Soros didn't see markets as perfectly rational machines. He saw them as giant feedback loops driven by human emotion, perception, and expectation. We don't observe markets from the outside. We participate in them, and our actions change the very reality we're trying to understand. In Soros's world, investors aren't just spectators, they're actors on the same stage. This idea challenges one of the oldest assumptions in finance, that markets always reflect objective value. Soros argued that people are imperfect. We all carry biases, fears, hopes, and incomplete information. Those imperfect perceptions influence our decisions, and those decisions move markets. The new market conditions then influence our perceptions again, creating a continuous cycle. Reality shapes beliefs, but beliefs also reshape reality. Perhaps the greatest demonstration of this thinking came in 1992, during Britain's currency crisis. Soros believed the British pound was overvalued and that the government couldn't defend it forever. As more traders began sharing that belief, they sold the pound aggressively. That selling pressure weakened the currency further, making Soros's original thesis increasingly true. Eventually, the Bank of England was forced to withdraw the pound from the European exchange rate mechanism. Soros reportedly earned more than $1 billion from that single trade, earning the nickname the man who broke the Bank of England. It wasn't just economics at work, it was psychology amplified through collective behavior. Reflexivity isn't limited to currency markets. We see it in housing bubbles, cryptocurrency booms, technology stocks, and even social media trends. Optimism fuels buying. Buying fuels higher prices. Higher prices create even more optimism until reality can no longer support expectations. Then the cycle reverses. Fear replaces confidence, selling accelerates, prices fall, and pessimism becomes self-reinforcing. For everyday investors, the lesson is powerful. Don't just ask whether an asset is cheap or expensive. Ask what people believe, why they believe it, and whether those beliefs are changing reality itself. Sometimes the biggest opportunities appear when the crowd mistakes temporary perception for permanent truth. Other times, the greatest risk lies in believing a story simply because everyone else believes it. Ray Dalio often reminds us that understanding how systems work is the key to better decisions. Soros adds another layer. Remember that human psychology is part of the system. Markets are not just numbers on a screen. They're living reflections of millions of minds influencing one another in real time. The next time you watch prices soar or collapse, don't just ask, what happened? Ask a deeper question. What did people believe that made this happen? Because in investing, the most powerful force isn't always money. It may be the stories we collectively choose to believe.